Most people have never seen their financial plan nor their retirement plan with this as an investment option or allocation offering different protections and growth potential that is mathematically proven to work when understood correctly and most importantly implemented correctly on here. Now today we're going to be going over is the S&P 500 index, which is the most common talked about on the stock market here that the majority of people are aware of. Now, this particular strategy and tactic, it could be utilized in your 40s, in your 50s, or even on your 60s, and it can be used in the IRA account, that Roth IRA account, or even that non-qualified, non-retirement brokerage type account as well. Now, this today is going to be all about education and for awareness and for the empowerment of choices on here. Several math, science, data, and charts we'll be going over so that you can retire earlier, wealthier, and or happier. You can have some peace of mind. You can have some protections on there. You don't have to have so much stress and have so much fear and so much anxiety as one tactical component in your overall plan for these protections and growth choices on here. Now, before we go any clearer on here and any further moving along, to remind you, this is educational only, not financial, tax, or legal advice. And everything you're going to see here digging today, it's going to be based on math, based on science, based on data, and pros and cons here as well. Now, my name is David Lundberg. I am a wealth and tax strategist. I've been helping out individuals and families since 2015. I do have 2 master's degrees, a certificate in financial planning, and a Marine veteran as well. Now, before we move along here today to show you the actual portfolio options, A versus B, pros and cons, we have to go over the building blocks, get an educational baseline understanding here on this, that we can understand what these actually look like. Now, this is about real people, real lives, real impacts, and real results. It's from hundreds of people that we have helped personally on here, from thousands of people we taught, but it's also from thousands of more advisors around the country and so many well-known experts and authors that have shown this data on here that far too many have not seen and far too many are unaware of, which is why it's all about education and awareness here today on here. Now, again, like any strategy, like any tactic on there, there's so many out there. You just need to understand, what is this? How could I potentially use it? What are the impacts on my own life, the pros and cons? And is it something I might want to ask more questions about? That's what we're here to help you today to decide, is to see what it is, how it works, and different ways you can design this or set this up. Now, before we move on here, we have to first go over what is volatility? What is risk? What are break-even points? Well, some people don't understand, but in the market, there's always some kind of volatility, right? Whether it's an economic condition, maybe the Feds are going to raise interest rates, keep them the same, or lower them. Maybe there's inflation. Maybe there's an economic thing occurring with AI that's happening right now. Maybe there's an under number of figures, but there's always some kind of volatility that is occurring that is out there. There's always the risk, right? Could a market crash happen? It could. No one knows when. Could a correction happen? It could. Could the markets continue to go up for the next several years? I mean, that could happen as well. These are all unknown variables, but there's always a risk associated with that. So in this chart coming up here on the screen right now, we're going to take a look at here what it's called the break loss chart on here. And it's a popular chart I've shown in my classes here for a number of years, and I really have enjoyed on here just to give you an overall visual breakdown on what this is. So we'll see here on the top left, the portfolio is down. It's kind of circled in the red. So we'll say, well, if my portfolio is down 30%, let's call it a crash that may have occurred on there, how much do I need to break even? Well, if you lose 30%, you need 43% to break even on what you lost. You can see on there as well, if you lost 20%, you will need 25% return just to break even. Now, if I went down 30% and we need a 43% return just to break even, the numbers on the top there would say, well, based on the average interest rate, 3%, 5%, 8%, 10 or 12%. In this case, we have an 8% rate of return was happening. It would take you roughly 4.5 years to break even. So if you lost 30%, you need a 43% return to break even, and an 8% rate of return, roughly 4.5% years. Now, let's say if you had a 12% rate of return that was occurring in that same scenario, it would then take you about 3 years to have a break even on there. Now, all of this also assumes what's called the sequence of return risk. And that assumes on there, hey, if I don't take any money out of my portfolio and I allow it to recover, then yes, if it drops 30%, I need 43% on there. If I have an 8% average return, in 4.5 years, I'll have broken even. However, if you take money out of that account to live on, or you take money out of the account for any other reason, you're not ever going to break even because now you are withdrawing or taking money out of that account as well. So it's just very important to keep in mind on here the potential of risk, the potential of loss, never as fear, but as education and awareness on there. That way you know the possibilities of what can happen in your life too. Now, the other thing we're going to look at on here is, hey, on the S&P 500, what have been the various corrections or various crashes over time? Again, for awareness, you have understanding of these things can occur. So this next chart that is now coming up here on the screen, we're going to take a look here. Hey, over these last couple of decades on here, one of the last big corrections or crashes, even if they have recovered, they did occur. So you can see we had one in January 2022, October 2022, we were down about 25%. Before then, we had February 2020 to March 2020, down about 33%. Then, of course, we had the housing crisis that had occurred, anywhere from a negative 50% to a negative 27%, and you can kind of see so on and so forth throughout time. So again, the point of this is not to give you fear or anxiety. The point is to show you that these crashes do happen, these corrections do happen, so you need to plan ahead for these, be proactive for these. Otherwise, you can have a great loss that can occur in your portfolios, and if you already are retired or you're waiting to retire earlier on here, these can have a huge impact on your ability to retire earlier, or a huge impact on how much money you can spend in retirement as well, which is why having some protections are so important in your overall portfolio. Now, this is why to me, protections, it's not about fear. It's not about stress. To me, protections, it's love, right? It's love for oneself. It's love if you're married with your spouse. It's love if you're married with your family. As a husband, as a father, as a Marine veteran, as a business owner, and so much more out there, right? I want to have protections in various ways. Protections are not here to limit me. They're not here to hinder me. They are here to give some kind of peace of mind and some kind of safety net. That way I know myself, my wife, my kids, my own early retirement, my retirement, all of the people we have helped when they're retired on there, having some kind of tactical protection of peace in there allows them to continue on with the lifestyle they have as opposed to so much great loss on there. So next coming up on here now, we're going to look at on the showing the S&P 500 index, various protections and various options you can have in the IRA, that Roth IRA, or that non-qualified, non-retirement brokerage type of account. Now, this coming up here on the screen, you're going to see 6 big square boxes. We get a review on here. Now, again, you can have some different options with your money on here. So maybe we go your 0% floor and a potential 9.25% or 9.25% return you can get. Simply means on there that your principal amount of money you put in, say $200,000, no matter what happens, your $200,000 is safe or guaranteed from protection. So now this is based on the growths we could have on here. So maybe we say year one, I want to go ahead and have a 0% floor on there, and I want to have a 9.25% potential rate of return. So if the S&P 500 goes up to 9.25%, you would get 9.25%. If it goes to 5%, you get 5%. If it's negative or crashes, your worst case is 0%. Now, if it goes to 15%, the most you can get would be 9.25%. However, let's take a look here at what we have on the negative 10% floor option with a 16.25% or 16.25% you can return, you can get on there. Now, with that floor, it means, hey, year one, maybe it had growth up to $220,000, a $20,000 growth that might have happened. Well, let's say in year two on there, you have a negative 10% floor. So it means the worst case you can lose on that $20,000 is 10% on that $20,000 is what you can lose on there. But now you can get up to 16.25% growth in the S&P 500. So same scenario. If it goes to 5%, you get 5. Goes to 10, you get 10. If it goes to 16.25% return in that 12-month period, you get that. Now, if it goes to 20%, you would not get that. But again, if there's a crash on there or something is negative, your worst is you have a negative 10% floor on those growths that you have occur on there. And then there's also the other option of that negative 15% floor. And again, on there, that potential 20%. So these are different ways and different allocations of how you can have maybe half of your money at a 0% floor, half your money at a negative 10% floor on here. Different ways you can allocate the money and set it up on there in this account types for varying protections on there. Now, what we're looking at next on here is actual scenarios or portfolios. We're going to have portfolio A, which is going to have some different protections on there. Portfolio B, which doesn't have any protections on there, and it doesn't have any limits or downsides either on there. We're going to mathematically look at the two of these on here and just compare numbers to numbers in the same scenarios too. That way you can get a visual of how this can look. So this next screen coming up on here, you're now going to see portfolio 1, and it's A, portfolio 2, which is B on here. Now, in portfolio A and portfolio B, each one is starting off with $200,000. And you could see that in the column on there, starting off with $200,000 each. You can also see in the yellow vertical box is the credit or the return on there. And then we can see in the far end, the green box on there, that is the ending value on there. And again, we're keeping it the same. So $200,000 year one. Now what's gonna happen is year one, portfolio A, it only gets that 9.25% return, as you can see, as opposed to portfolio B on there that has no protections, it got a 13% rate of return on there, which is greater. So at the end of year one only, we already have portfolio A, we're now going to $218,000 roughly. Portfolio B, $226,000. Year two on there, they each get a 12% credit, or each get a 12% rate of return as a carrot on there. And that's because in year two on there, we had elected that negative 10% floor with that 16.25% potential cap on there as well. Now the big difference on here is in year three, we have now elected in portfolio A a negative 10% floor on there is what we have elected. So that negative 10% floor that can occur on there as well. And in B it does not. But in year three in that red box across, you can see, hey, we had a 25% crash or correction on the S&P 500. Portfolio A that was protected, we had that negative 10% floor that occurred on there that limits the loss we can have, and that negative 10% is applied to that growth amount on there, which you can see. As opposed to a portfolio B in year three, that has a 25% crash, that one had no protections on there, so it loses the full 25%. So now in year three on there, portfolio A with the protections, roughly $220,000. Portfolio B that had no protections now has $189,000. That's a huge difference already occurring on here. Now we go to year four on here. Portfolio A on there got that 12% credit on there. Portfolio B also got that 12% credit on there. Portfolio A year five got that 13% credit on there. Portfolio B, year five, got that 13% credit on there. So after just 5 years on here, portfolio A that had the different protection options and growth potentials on there ended at about $278,000. Portfolio B that never had the protections on there ended with $240,000. Now, keep in mind as well that portfolio A having those protections in place and the different growth potentials in place, that person always had that peace of mind. That person didn't have so much stress, fear, anxiety, and unknowns, as opposed to portfolio B, they always had to wonder what if. They always had to wonder the stress. Something happened in the economy, something happened in America, something happened globally. There was always that worst case scenario on there, whereas portfolio A had some protections on there. They didn't have to worry as much, which is why it's important to have a tactical component in your overall plan that allows for some protections, but still giving the upside potential as well with the S&P 500. Now let's take a look here at another easier chart coming up here in that same situation on there, portfolio A and portfolio B. Again, A is the one that had the protections with different growth potentials. B didn't have any protections. In portfolio A, you had that peace of mind. Portfolio B, you had the stress and the what ifs. Now again, they both started with $200,000. As we saw, was really in year three on there where we had that correction or crash occur, but portfolio A only had that negative 10% drop that occurred in the growth due to the floor it had, whereas portfolio B had no protections and took the full hit of that negative 25% return. That is why at the end of all 5 years on here, portfolio A ends with $278,000. Portfolio B ends with $240,000 on here. Now, this is assuming, of course, hey, if one correction happens over the 5-year period, then A most likely is always going to beat it out on there. Portfolio B would only usually win if there's never a crash and if there's never a correction, and if you had very high returns, 10, 12, 15, 16% in the S&P 500, even though it only averages historically about 10 to 11% historically on there. Now, again, it's just one tactical component or one tactical piece in your overall portfolio. That way you can have some safety, and that way you can have some protections that can occur in there as well. Because the whole point about this, again, right, it's not about fear. It's about choices. It's about education. It's about awareness. So if you can have some of your money from your IRA, your Roth IRA, or that non-qualified non-retirement account with some protections, with some different growth potentials, with some different floors on that can occur, why not at least be aware of those and see how it can work in your own plan? That way, if you're trying to retire earlier, you have some protections in place to help you. Maybe you're already in retirement and you want to travel, go on vacation, you have all these expenses on there, but you can have some protections in your overall plan. Because remember, this is just one tactical component of the overall plan. When you have those stocks, ETFs, mutual funds, bonds, real estate, maybe a number of other things out there, but it is so important as a tactical component in an overall plan, in my opinion, opinion on here that if you want to retire earlier or retire in greater peace and protections and clarity, you need to have some kind of protections in place. So why not at least be aware of these on here so that you can make the best choice for your own self and be aware of options that are available to you as well.